This is a story about setting goals that are realistic, but also that are the right ones. Our colleagues Alex Steele and Michael McKee take a look at the president's goal of getting gasoline below $2 a gallon.
A cornerstone of President Trump's economic agenda is lower gasoline prices.
Energy is going down. I see that we had a couple of states where gasoline was at $1.98 a gallon.
$1.99 might be a stretch now. If President Trump gets his wish of $40 oil, it could be a reality.
The number one thing that sets the price of gasoline is the price of crude oil. And as we've seen gasoline prices drop over the past year or so, the thing that's driven that above all is the price of crude oil coming down. So simple as that, really.
Ed Crooks is vice chair of the Americas at Wood Mackenzie, a leading data and analytics firm. Crooks says it's possible we get another oil price crash like the one we had in 2016, which dragged oil down to $26 a barrel and pump prices to $1.70.
It's certainly possible that we can get back to a point like the situation we were in 2015, 2016, where we had very low oil prices down below $40 a barrel, and that led to very cheap gasoline. So we might have a period, maybe a year or two, with very low oil prices, very low gasoline prices.
Why does it always feel like prices at the pump go up faster than they go down?
There is some evidence on that. If you think about it, though, take a step back, you think about the big picture, then people will say, well, because of these movements, because of gasoline prices going up faster than they come down, therefore refiners must be making fantastic profits.
The reality is, the price of oil only accounts for half of the price of a gallon of gasoline. About 30% is then equally split between federal and state taxes and distribution and marketing, moving the gasoline around the country and selling it at the gas station. The rest are those refining costs and profits.
Refining is not a hugely lucrative business. In fact, particularly right now, profit margins in refining have been squeezed right down. It's really hard to make a good return in the refining business.
No one knows that better than Andy Walsh, president of Downstream, Midstream, and Chemicals at Chevron.
We're trying to buy low and sell high. It's just like if you were to run a restaurant, the raw materials you buy and the meals you sell to people, that's the restaurant's crack spread. Same exact concept in refining.
It's Andy's job to make sure the 1.8 million barrels of oil products a day that Chevron produces flow safely, efficiently, and profitably. More than half of that comes from the U.S.
I mean, this is huge. Give me some perspective on how big this all is.
Yeah, so the whole property is about 3,000 acres. Most of the processing stuff is on about 1,000 acres, so it's a really big facility, a lot of complex things going on here.
Chevron's refinery in Pascagoula, Mississippi runs 24/7, takes 35 different types of crude and turns it mostly into gasoline, diesel, fuel for jets, ships, railroads, and farm equipment, and even propane, what you may use for your barbecue.
We're either breaking down molecules, putting molecules back together, we're taking some product out of it, maybe it's sulfur, maybe it's a metal, we're squeezing it, we're making it very hot, but we're doing a lot of chemical things to take a raw material and turn it into a thing like gasoline.
The oil is separated, pressurized, and heated more than a dozen times to keep changing the molecules. It's complicated work with razor-thin margins.
And I wish I had more control over margins. I really don't. It's based on supply and demand, and if margins are good, we really want to run. If margins are bad, we still need to run.
And so I think when people kind of take that jump to say, this is outrageous, the oil companies are ripping us off, and they're making so much money out of refining, that's not really accurate at all.
If refiner greed isn't a hurdle to sub-$2 gasoline, supply might be. Over the past decade, 10 refiners have closed, either because of damage or because they transitioned to process renewable fuels.
Refineries have been closing down. As you know, in the US alone, Lyondell shut down earlier this year. So this is another problem that, yes, while crude oil prices are going to be low, it's not necessarily the same case for what you and I consume, which is gasoline and diesel.
Amrita Sen is the founder and director of market intelligence at Energy Aspects, a global data and intelligence firm. Sen is one of the most prolific voices in the industry.
The one thing I'm very, very confident about is on that refined products markets, because the volume of refineries we are continuing to shut down and just modest demand growth for gasoline, diesel, and jet will lead us to some significantly higher pump prices.
COVID also did permanent damage to the industry.
Yeah, COVID was a challenging time for our industry. That was hard. running the plant at minimum was hard. In fact, it ended up making several refineries in the United States close. It was either impossible, uneconomic, or super difficult. And we lost a lot of refineries in the U.S. And they're probably never going to come back. Once you close a refinery, I think it's kind of the end of the line. And it's sad, but that's what happened.
So what does that do for a supply-demand dynamic when it comes to, say, gasoline?
It makes it tighter. Yeah, if somebody that used to make gasoline is no longer making it, others have to pick up the slack and have to do it.
The U.S. hasn't seen a new large refiner since 1977. Smaller ones have been built and existing plants have expanded. U.S. capacity is now at 18.4 million barrels a day. The real problem is coming. California will see almost 1/5 of its crude processing capacity vanish in the next 12 months after Valero and Phillips 66 idle a combined 284,000 barrels of daily refining capacity.
The problem is from 2027 onwards, if you look at our refining kind of global landscape, it only gets worse. We've got more closures coming because refining is such a slow-moving industry, right? 7 years it kind of takes to build one, and there are no new builds in the West anyways. So I think we are in for a period of very high refined products prices, even if crude doesn't go up, by the way, regardless of what you think crude's going to do. And you could disagree with me and say, oh, no, demand's not going to be great, and, you know, shale will bounce back, whatever. We can disagree on that.
$2 gasoline is definitely not a good sign for the oil industry. The U.S. is now the largest producer in the world, a different dynamic than previous oil sell-offs.
The crude price that you'd need to get gasoline down to $1.99 is one that would be absolutely miserable for people in the US oil industry, for oil producers. It's certainly a level that would lead to job cuts. It's a level that would lead to rigs being laid down, people drilling less, and so on.
Most Americans agree they would like lower gasoline prices, but that might not actually be good for the country.
I think, though, you've got to think about gasoline as being a bit like a health check, a barometer, temperature check. If you do see gasoline prices really kind of starting to plumb the depths and go significantly below where they are today, that's probably a sign that all is not well in the world economy.
We need to think about what's this cycle going to look like, because, again, it was not some fundamental shift in the market for oil that caused this particular cycle to be intensified. It was some tariff policies that may or may not be permanent. We don't know how that's all going to shake out. The most typical economic reaction to uncertainty is to do nothing. Don't buy that car, don't buy that house, don't bring out that new product, don't make that investment. All of those things, we tend to just lay back and do nothing. If the uncertainty ebbs to some extent, I think you'll see global demand coming back pretty quickly. This may be a fairly short cycle if that happens.
Ray Perryman is an economist who's been studying the economic effects of oil prices for 40 years.
Our most recent study indicated that today, if you take the oil that's produced in the Permian and then you look at the downstream, the upstream, and everything else that happens with the oil produced in this region, it's responsible for about 1 million jobs in the United States.
Texas is an intersection of the economic fallout from low oil prices and producers taking their foot off the gas. Kirk Edwards is an oil and gas producer who is seeing the ripple effects in the Permian Basin firsthand.
It's the rest of the country that benefits from the gasoline price. Again, people in Midland, Odessa, we would rather see higher gasoline prices because it means the oil price is good and the economy is going to be good. But it is a side effect for everybody because everybody has to use gasoline in their cars right now to go to work and fly and do things like that.